Morning, everyone. Thank you for joining our webinar today describing the topic Union Budget 2026. My name is Harshdeep Singh. I am Assistant General Manager in the Business Development Department at MBG Corporate Services. I'm delighted to be your host for today's webinar. Before we dive into the topic, let me introduce our company, MBG Corporate Services. MBG Corporate Services is a premier business solution provider with a proven track record of helping companies thrive in today's dynamic business environment. Our mission is to empower businesses with tools, knowledge, expertise needed to succeed. Established in 2002 and headquartered in Singapore, we are a team of 600 plus professionals operating out of Europe, Middle East, Asia, with a network of 16 plus global offices in 8 countries. Over the past 2 decades, we have served more than 5,000 plus clients globally, including 100 of Fortune 500 companies in the regions such as Middle East, Europe, Japan, Singapore, and India. With an innovative approach to every project, and every unwavering commitment to quality and consistency, we have played an instrumental role in transforming businesses worldwide. MBG Corporate Services operates in a specialized international enterprise teams dedicated to assisting clients in various geographies, regions across the globe. These teams focus on providing tailored services, support clients based on the specific regions, including India, Japan, Middle East, China, and Europe. By establishing dedicated teams for these key geographic regions, MBG Corporate Services demonstrates a strategic approach to understanding and meeting the distinct needs of clients in different parts of the world. This enables us to provide more effective and targeted service, fostering strong client relationship and successful outcomes in each region. What makes MBG different? What sets us apart is our 360-degree advisory approach. By integrating multidisciplinary perspectives, we ensure our clients get well-rounded solutions to complex business challenges. This holistic approach leads tailored strategies for growth and compliances. End-to-end solutions for businesses. We can support businesses across their life cycle, starting from pre-launch to growth, shakeout, and beyond. Our solutions cover every stage of a business lifecycle from a pre-launch feasibility study to market entry, risk management, expansion strategies. Whether you are looking to diversify, increase profitability, or enter into new markets, we have the expertise to guide your journey. So let me give you snippets of each service verticals offered by MBG Corporate Services. Market research and market entry services. We help in conducting in-depth market research and analysis, identify opportunities, market trends, and potential challenges for successful market entry. Risk advisory, conducting comprehensive risk strategies tailored to specific industry and organization needs. Transaction advisory, conducting through the diligence assessment for merger, acquisition, and transactions to evaluate financial, legal, and operational aspects. Taxation services, developing tax efficient strategies to minimize tax liabilities and optimize financial resources, and assisting in tax compliances, filing tax returns, liaising with tax authorities on behalf of the clients. Financial reporting and assurance, conducting audits to accuracy, completeness, financial statement, and assurance to stakeholders. Corporate and regulatory advisory, covering contract management, regulatory advisory, legal and secretarial services. Human capital consulting includes people development, HR, payroll, and compensation benchmarking. Each of these service verticals demonstrate MBG Corporate Services' commitment to offering solutions and diverse needs of clients across various industries. Now, allow me to introduce our speaker, Mr. Love Malhotra, who is our COO and partner for the legal services. He has 16 plus years of experience in corporate, regulatory, and cross-border legal advisory. Over to Love.
Thank you, Ajdeep. Good morning, everyone. I'll begin today's session by briefly taking you through the macroeconomic overview as highlighted in our economic survey, followed by the key focus areas and initiatives of the Union Budget 2026. Like every economy, the Indian economy also revolves around key indicators such as GDP growth, inflation, fiscal deficit, and forex reserves. I shall now provide a comprehensive overview of each respective measure. Starting with the GDP growth, as per the economic survey, India's growth outlook remains strong despite a challenging global environment. While the survey projects real GDP growth of 7.4% in FY26, with potential growth of around 7%, looking ahead, growth in FY27 is expected to be in the range of 6.8% to 7.2%, reflecting sustained medium-term growth capacity. This growth is supported by robust private consumption, which accounts for 61.5% of GDP, healthy investment momentum with gross fixed capital formation growing by 7.8%, and a strong service-led expansion with services GBA increasing by 9.1% in FY26. On the inflation front, the domestic outlook has been particularly encouraging. Domestic inflation averaged 1.7% during April to December 25, making the lowest level recorded since the inception of the Consumer Price Index series. This moderation has been driven largely by easing food and fuel prices, which form a significant part of the CPI basket. Notably, among major emerging market economies, India recorded one of the sharpest declines in headline inflation in 2025 as compared to 2024. Looking ahead, the inflation outlook remains comfortable, supported by favorable supply side conditions and ongoing rationalization of GST rates, providing stability to prices while supporting growth. Next is forex reserves. Well, India's foreign exchange reserves continue to remain strong and adequate. As of mid-January 26, reserves increased to USD 701.4 billion, providing an import cover of approximately 11 months and covering over 94% of external debt. These comfortable reserve levels significantly strengthen India's ability to absorb external shocks, enhance investor confidence, and ensure stability in the external sector. Now, survey highlights India's prudent fiscal management, which has strengthened macroeconomic credibility and contributed to sovereign credit rating upgrades in 2025. The center's revenue receipts improved to 9.2% of GDP in FY25, supported by tax collections and better compliance. As a result, central government's fiscal deficit is estimated to decline from 4.8% of GDP in the previous year to 4.4% of GDP in FY26, reflecting continuous fiscal consolidation. At the state level, fiscal performance has remained broadly stable in the post-pandemic period. Importantly here, it is worth noting that despite maintaining high public investment, India has reduced its general government debt to GDP ratio by about 7.1% points since 2020, underscoring the quality and sustainability of fiscal management. Let me now briefly touch upon the key sectors which has contributed to the growth and development of the Indian economy. Starting with the agriculture. Well, the performance of agriculture sector remains critical for the economy's growth. Over the last 5 years, the sector has grown at an average of 4.4% with 3.5% growth in Q2 of FY26. Growth during financial year 2016 to 25 was driven mainly by allied activities with livestock and fisheries growing at about 7.1% and 8.8% respectively. Food grain production reaching a record 3577.3 lakh metric tons in agriculture year 24-25, strengthening food security and rural incomes. Next is industry. Well, industrial activity strengthened significantly in FY26, reflecting a broad-based recovery in the manufacturing sector. The production link incentive schemes across 14 sectors have driven India's industrial momentum, attracting nearly INR 2000 billion in investments and boosting production, employment, and technology adoption. Further, progress in semiconductors and innovation-led manufacturing has definitely boosted India's industrial ecosystem and global competitiveness. Likewise, in FY 25-26, the service sector is projected to grow by 9.1%, as you can see on the screen, which is driven by strong performance in IT, finance, logistics, and tourism. It continues to attract the bulk of investment, accounting for over 80% of total FDI during FY 23 to FY 25, and contributed 51.7% of net EPFO employment additions in early FY 26, highlighting its key role in growth and job creation. Now let us move to Union Budget. While presenting the Union Budget for FY 26-27, the Finance Minister highlighted that the Sankalp or resolution of this budget is to focus on poor, underprivileged, and disadvantaged. Now, to deliver on this Sankalp or resolution, the budget is inspired by three Kartavya or duties. First Kartavya being is to accelerate and sustain economic growth. Second being to fulfill the aspirations of people of India and build their capacity. Third being with the vision of Sabka Saath, Sabka Vikas. So it is with this context that Union Budget has been introduced. Now in the next slide, we'll see the key initiatives proposed under each of these three duties or kartavyas. As discussed earlier, the union budget is anchored around three duties, and the initiatives on this slide are aligned with those duties and the broader vision of developed India at 2047. Under the first kartavya, productivity, manufacturing, and competitiveness to support long-term growth is emphasized. So key initiatives here are Biopharma Shakti with an outlay of INR 100 billion, India's Semiconductor Mission 2.0, and an enhanced electronic manufacturing push, coupled with the development of rare earth corridors and integrated textile programs to boost scale, productivity, and employment. Now, aligned with the second Kartavya, the budget focuses on human capital, tourism, and social infrastructure. This mainly covers healthcare expansion through regional medical hubs, strengthening the allied health workforce, and support for Ayurveda institutes. Now, education reforms are also proposed through university townships and girls' hostels in every district, while tourism, heritage sports, and creative economy, including AVGC, are positioned as key employment and aspiration drivers. Under the third Kartavya, Sabka Saath, Sabka Vikas, that is collective effort coupled with inclusive development, the budget emphasizes on reforms and ease of doing business. Now, here, public capital expenditure has been increased to record breaking INR 12.2 trillion as a growth multiplier, supported by 7 high speed rail corridors to improve connectivity and integration. Similarly, MSMEs are to be strengthened through the INR 100 billion SME Growth Fund, cluster revitalization, and risk capital support. Further, initiatives such as AI-enabled agriculture under Bharat Vistar, enhanced water security projects, focused development of Northeast, increased portfolio investment under the PIS scheme, and a simplified FEMA framework collectively promote inclusion and ease of doing business. Taken together, these measures operationalize the three kartavya or duties, translating vision into action and accelerating India's progress towards a Viksit Bharat or developed India by 2047. Now, let us move to the sectoral analysis. Whereas earlier, we have categorized the policy reforms into agriculture, physical infrastructure, digital infrastructure, education, manufacturing, financial sector, reforms for MSME, and healthcare, based on their contributions to economic growth of the nation. Starting with the agriculture, it remains a core pillar of the economy with key measures focused on boosting productivity and farmer incomes. Major initiatives include expanding the veterinary workforce, targeted support for small and marginal farmers, integrated development of reservoirs to strengthen fisheries, promotion of high value crops, and strengthening livestock, FPOs, and rural entrepreneurship to generate rural and peri-urban employment. Now, just like agriculture, infrastructure remains a key growth driver with higher public capex, a new infrastructure risk guarantee fund, monetization of CPSE assets through RITs, development of city economic region in tier 2 and tier 3 cities, and of course, expansion of high speed rail and freight corridors, strengthening connectivity, logistics, and regional growth. Next is digital infrastructure. Well, it remains a key enabler of governance and growth. Continued investments in digital public infrastructure, AI driven solutions, and broadband connectivity is expected to further strengthen service delivery, financial inclusion, and productivity across sectors. Next one is education. Union budget prioritizes higher education and skill development through stronger industry academia linkages. Key announcements in this sector include setting up of 5 university townships along major industrial and logistics corridors to create employment ready talent, establishing a girls' hostel in every district to promote gender equity in STEM education, and strengthening research in astrophysics and astronomy through new and upgraded facilities. Next one is pretty important, manufacturing sector. Well, the union budget places strong emphasis on strengthening domestic manufacturing capacity across key sectors by enhancing support for electronics, chemicals, containers, textiles, and sport goods, while promoting indigenous production, sustainability, and technology upgradation. Key measures here include higher outlays for electronic manufacturing, new chemical parks, container and carbon capture programs, textile sector reforms, and targeted revival of 200 legacy industrial clusters are considered to be welcome moves to boost productivity, quality, and global competitiveness. The budget now focuses on introducing a series of financial sector reforms aimed at strengthening capital markets and supporting long-term growth. First important piece of reform is relaxation of investment norms for persons resident outside India by allowing higher participation in listed Indian equities under the portfolio investment scheme, increasing individual limits from 5% to 10%, and aggregate investment limits from 10% to whooping 24%. Further, a comprehensive review of forex management non-debt instrument rules is proposed to establish a modern, user-friendly foreign investment framework. Now, to align a banking system with India's evolving growth curve, a high-level committee on banking for developed India is being proposed in this budget. Government also introduced several strategic measures to modernize India's debt markets, which focuses on improving liquidity in corporate bonds and providing a multi-tiered support system for urban infrastructure through municipal bonds. Next is reforms for MSME. The union budget continues to recognize MSME as a key engine of economic growth and employment. The budget talks about creation of future champion SMEs. Now, in this regard, there is a proposal to set up a INR 100 billion SME growth fund along with a top up of INR 20 billion to the Self-Reliant India Fund, which is aimed at supporting micro enterprises and strengthening access to risk capital. Further, the budget seeks to improve MSME liquidity and ease compliance by mandating central public sector enterprises to use TREDs, enhance credit guarantee mechanisms, strengthening linkages with GEM portal, enabling securitization, and creating accredited corporate mitras to provide affordable compliance support, particularly in Tier 2 and Tier 3 towns. Next one definitely cannot be ignored: healthcare. The union budget prioritizes strengthening India's healthcare ecosystem through capacity expansion, traditional medicine, and improved access. Key measures here include strengthening the Ayush ecosystem through new Ayurveda institutes, upgraded pharmacies and labs, global research support, and export promotion alongside expanded training for allied health professionals and geriatric caregivers. Now, to boost medical tourism, 5 regional medical hubs are proposed, while mental health care will be strengthened through NIMANS 2 and upgraded national institutes. The budget here also proposes expanding emergency and trauma care capacity in district hospitals to reduce financial burden on vulnerable families. Now, to conclude here, the Union Budget 26 sets out a balanced and forward-looking roadmap focused on growth, infrastructure, manufacturing, human capital, and ease of doing business. Collectively, these measures strengthen India's path towards a resilient and competitive Viksit Bharat by 2047. Thank you for patient listening. Over to you, Harshdeep.
Allow me to introduce our next speaker, Mr. Janardhan Singh, CEO India Operations and Partner Direct Tax. He has around 20 plus years of experience in international and corporate taxation. Over to Janardhan, sir.
Good morning, everyone. Thank you, Harshdeep, for the introduction. And thank you, Love, for sharing insights on macroeconomic overview. I am going to cover the key direct tax amendments proposed by Finance Bill 2026. We are standing at a pivotal moment in our fiscal history with the introduction of new Income Tax Act 2025 and the amendments proposed in the Finance Bill 2026. The government is indicating a clear intent. They want to move from a litigation-based regime to a compliance-based regime. Today, we are going to analyze key proposals of the bill which will impact the organization's compliance calendar, cash flows, and litigation strategy. So let's start with compliance timelines. Currently, under Section 263 of the new income tax law, sole proprietors and partners in firm not subject to audit face a deadline of 31st of July of the succeeding tax year for filing income tax return. The proposal extends this deadline for such assessees to 31st of August of the succeeding tax year. By pushing this to 31st of August, The legislation effectively decouples the salaried filing peak from the small business filing peak. This is effective from tax year 26-27. Moving to revised returns, this is a double-edged sword. The window to revise a return is expanding from 9 months to 12 months from the end of the tax year. Accordingly, taxpayers have now time until 31st of March of the following year to correct omissions or wrong statements. While the exact time or extra time is welcome move, it comes with a cost. A late fee is introduced, which is 1,000 for smaller incomes and 5,000 for others. A critical change has been proposed in relation with updated returns, which is one of the most significant procedural relief in this bill. Under the previous regime, the updated return facility was restrictive. Taxpayers couldn't use it to reduce a loss, nor could he use it once an assessment notice was issued. The government is now proposing to allow updated returns even if the taxpayer reduced the amount of loss originally declared. More critically, taxpayer can now file an updated return even after an assessment notice has been issued, provided he do it within the time specified in that notice. This is a litigation minimization tool. If taxpayer receive a notice and realize there is a defensible but weak position, he can now buy peace immediately by updating the return and paying the additional 10% tax. It effectively allows for a midstream settlement before the assessment order is passed. Modified return in case of APAs, this is a welcome move for the multinational groups with advanced pricing agreements. Previously, only the applicant entity could file a modified return post APA. Now the associated enterprise, the counterparty in the transaction, can also file a modified return to align with the APA signed by the applicant. This closes a technical gap. Often, one side of the transaction was adjusted due to an APA, the other side, the AE, was left with a mismatch, leading to double taxation or secondary adjustment issues. This adjustment effective 1st April 26 will ensure symmetry in transfer pricing adjustments. Compensation exemption, Motor Vehicle Act. So this is a social, or you can say socio-economic relief measure proposed by the bill. We see a full exemption on interest income awarded by the Motor Accidents Claims Tribunal. Also, the compliance burden of the TDS on the amounts over 50,000 is removed. So, compensation exemptions, compulsory acquisition of land. This proposal has broader impact. The distinction between agricultural and non-agricultural land is being removed for compulsory acquisition compensation. From 1st April 26, any land acquired under the RFCT LARR Act will yield tax exemption compensation for individuals and HUFs. So this removes the ambiguity that led to massive litigation on whether land was agricultural or urban. Incentivizing foreign investment, data and manufacturing, the government is clearly targeting the digital and high-tech manufacturing sectors. A massive holiday until 2046-47 for foreign companies procuring services from Indian data centers is proposed. This is designed to make India a global data hub. On the other hand, for boosting electronics manufacturing, an exemption is proposed until 2030-31 for foreign companies providing capital gains or tooling to Indian contract manufacturers. As per my view, this is the time to restructure foreign companies' supply chains, moving tooling ownership to the foreign entity while keeping manufacturing in India in a bonded area is now significantly more tax efficient. Non-resident reliefs, MAT and professionals. So these are two key relaxations for non-residents. Firstly, foreign companies operating cruise ships or setting up electronics manufacturing are now exempt from MAT. This lowers the entry barrier. Secondly, a 5-year tax holiday for non-resident individuals rendering specific services in connection with schemes notified by central government and fulfilling prescribed conditions. So this covers income accruing outside India. It has likely targeting at bringing in specialized technical consultants for infrastructure or high-tech projects without triggering a complex tax residency trap in their first few years. Distillation of lower deduction certificate. So this proposal shows focus on achieving operational efficiency. For small taxpayers, the application for lower or nil withholding certificates is moving fully electronic. We expect this to reduce the processing time significantly. The prescribed authority will now issue or reject based on automated prescribed conditions. For companies, this means faster cash flow realization, but it also implies that application data must perfectly match the department's record. There will be less room for manual explanation in such a case. TAN relaxation for property buyers. This is a major compliance relief for real estate sector. Currently, if a person buy property from a non-resident, he need a TAN to deduct tax. Effective 1st October 26, resident individuals and HUFs are exempt from obtaining a TAN for these transactions. This simplifies cross-border property deals significantly because now they can easily do such type of deals. The buyer can likely use their PAN similar to buying from a resident, removing a major friction point in NRI property sales. So next is revolving or around the manpower supply dispute. So this is a resolution which is provided. So this is another move to reduce litigation. The eternal debate is whether manpower supply is a contract covered under section 194C or technical service covered under section 194J. To settle this argument, the bill explicitly classifies supply of manpower as work resulting in TDS at the rate of 1% on payments to individual and HUF and at the rate 2% for other than individual and HUF. This brings certainty. However, one has to verify the contracts entered with vendors. If one has deducted at the rate of 10%, this amendment will provide a cash flow benefits for the vendors. Further, in case one was deducting at the rate of 10% on such payment, one has to remap the ERPs to 1% or 2% rate effective 1st April 26. TCS rate realization. So we see a recalibration of tax collection at source. TCS on syn goods such as alcohol and resources such as scrap, coal, minerals are proposed at the rate of 2%. This will slightly impact working capital for manufacturing and mining companies. Also, TCS on remittances under LRS for education and medical drops from 5% to 2%. Further, the aggressive 5% and 20% slab for overseas tour packages is replaced by a flat 2%. This is a massive relief for the travel industry and corporate offsites. The new penalty regime. Now, I want you to pay close attention here. The philosophy of penalties is changing. The penalty for underreporting will now be levied directly in the assessment order. Resultantly, assessee will lose the cooling off period between assessment order and the penalty notice. The defense against the addition and the penalty must now be simultaneous. Rationalization of penalties into fee. The procedural defaults such as audit report delays and SFT failures are being converted from penalties to fees. Penalties can often be argued away with reasonable cause. On the other hand, fees are mandatory and automatic. There is no discretion for the tax officer to waive the fee. Rationalization of tax and penalty on unexplained credits. So in case of unexplained credits, the tax rate is slashed from 60% to 30%, and 10% penalty is also removed. This suggests the government wants to recover tax rather than destroy the taxpayer's net worth in these cases. So next is penalty related to statement of crypto assets. Reporting is getting tighter. Prescribed reporting entity has obligation to furnish information in respect of transaction in a crypto asset in a statement. To ensure compliance and deterrence for non-furnishing of the statement or for sharing inaccurate information in the statement, a specific penalty of 200 per day for non-furnishing of the statement and 50,000 for furnishing inaccurate particulars in crypto statements has been proposed. So considering such penalties provision, such entities have to ensure robust crypto reporting compliances. Rationalization of prosecution proceedings. So this is the ease of doing business move. The government is realizing that they have to decriminalize most of the things and penalties. So they have rationalized the prosecution. Rigorous imprisonment becomes simple imprisonment capped at 2 years. If tax evaded is less than equal to 1 million, there will be fine only and no jail provisions. Further, certain offenses, including failure to produce books of accounts and specified TDS related defaults, are proposed to be fully decriminalized. This significantly lowers the personal risk for directors and principal officers. Technical defaults will no longer hang the sword of imprisonment over corporate heads. Relaxation of conditions for prosecution under the Black Money Act. So this is another move of easing compliances. Prosecution proceedings will no longer apply to the non-disclosure of foreign assets if aggregate value of such assets is 2 million or less. This amendment shall enable to rectify the default related to foreign assets such as dormant student bank account and employment related stock options that may have been inadvertently omitted from the previous disclosures. It will significantly reduce the legal risk associated with those specific assets, provided they fall below the monetary threshold. This relief is proposed to be effective retrospectively from 1st of October 24. Immunity from penalty or prosecution. To clean up the litigation pipeline, one can now claim immunity from penalty and prosecution for misreporting by paying 100% tax and for unexplained credits by paying 120% tax. This is an expensive but effective exit route. Now, move to Foreign Assets of Small Taxpayers Disclosure Scheme 2026. It is a proposed amnesty scheme designed to resolve legacy or inadvertent non-disclosures of foreign assets held by resident taxpayers. This scheme intends to cover undeclared foreign assets such as ESOPs, dormant or low value foreign bank accounts opened by former students while studying abroad, saving held by individuals who have returned to India, assets held by expatriates who were on overseas deputation. Extension of deduction and rationalization of tax rates for units in IFSC. For units in Gift City, there is 100% deduction on certain incomes. This deduction is available for 10 consecutive years out of 15 years. The tax holiday period is doubled, extended to 20 consecutive years out of 25 years. And even after the 20 years, the tax rate is capped at 15%. This ensures long-term competitiveness against global hubs. Time limit of assessments in case of DRP. This amendment is critical legislative intervention designed to overcome a series of judicial precedents that favor taxpayers. It clarifies that the timelines for completing assessment under the DRP are independent codes for in themselves and are not constrained by the general limitation periods prescribed under general assessment or search assessments. It is explicitly clarified that the timelines in section 153 and 153B govern the draft assessment order stage. However, the finalization of the assessment under section 144C operates on its own timeline. Hence, the specific timelines of section 144C shall prevail for final orders. Under OL Act, the clarification comes into force with retrospective effect from 1st April 2009 regarding section 153 and from 1st October 2009 regarding section 153B. However, under new act, it is effective from 1st April 2026. Under the existing provisions, the TPO is required to pass order at least 60 days before the limitation period expires for the assessing officer. To complete the final assessment, a significant dispute has arisen regarding how these 60 days are to be calculated. The government asserts that the intent has always been to include the date of limitation in the computation of 60-day period. Various courts have interpreted the provisions differently, often holding that the period of 60 days should exclude the date of limitation. To settle this interpretive variance and prevent the annulment of assessments on this technicality, the Finance Bill proposes a clarification. The amendment will legally codify that the computation of the 60-day period includes the date of limitation, thereby validating the department's method of calculation. The clarification is proposed to take effect retrospectively from 1st June 2007 under Old Act. This effectively seeks to validate past TPO orders that may currently be under litigation or were at risk of being challenged on this specific ground. The corresponding provision in the new Act will be effective from 1st April 26. Validity of assessments in defect on account of computer generated DIN. A retrospective amendment states that a defect in the computer generated DIN does not invalidate the assessment. This nullifies several pro-taxpayer court rulings that quashed orders on technical DIN grounds. Declaration for no deduction of tax to a depository. At present, the taxpayer has to furnish a declaration for no deduction of tax to the person responsible for paying income. A big relief has been proposed for retail and HNI investors. They are no longer need to file Form 15G and 15H with every single company. A single declaration to the depository will suffice to stop tedious on dividends. This move of centralization is efficient and appreciated. Due date for deposition of employee contribution by employer. This is critical payroll compliance update. To claim a deduction for employee contribution to PF and ESI, the employer must deposit them on or before the due date of filing the return of income. This appears to be a relaxation compared to previous strict interpretations that required deposit by the fund's due date to avoid disallowance. Rationalization of minimum alternate tax. The MAT rate is reduced to 14%. It is proposed that in old regime, tax paid under MAT is final. No MAT credit is allowed. On the other hand, in the new regime, MAT credit set-off is restricted to 25% of tax liability. As an impact, review of deferred tax assets shall be required to be done. In case there are huge MAT credits, the window to utilize them is narrowing. So provisions relating to income from house property. This is significant correction for individual home owners regarding the interest deduction on self-occupied property. We know that the standard deduction limit is of 2 lakhs for the interest on borrowed capital. However, the text of section 22 subsection 2 in the new act inadvertently created confusion. It did not explicitly state that this 2 lakh ceiling includes the prior period interest. Technically, this could have led to litigation where an assessing officer might disallow prior period interest entirely or treat it differently. The bill fixes this. It amends Section 22, subsection 2 to explicitly provide that the aggregate amount of deduction, that is 2 lakh limit, shall be inclusive of prior period interest payable. This restores the position we had under Section 24B of the old Act. To ensure that the amortization of pre-construction interest remains a valid claim, essentially preserving the status quo. So with this, I end my presentation and thank you for attending the session. My colleague Rashi will take you through the key indirect tax proposals in the next session. I am now handing over to Harshdeep.
Our next speaker is Ms. Rashi Paliwal, partner in direct taxation. She has around 13 plus years of experience in indirect taxation and litigation. So over to
Thank you, Harshdeep, and thank you, sir, for such an insightful session on direct tax proposals in the Union Budget 2026. Namaste and a very good morning to all the participants. I would like to take an opportunity to thank you all for sparing your precious time to have a session on proposals in Union Budget 2026 with them. From indirect tax perspective, we will be focusing on the legislative amendments in GST and custom laws. To start with, Clause B of Section 15, subsection 3 of the CGST Act 2017 is replaced with new provision. As can be seen on the screen, the existing section provides that post-sale discount should be established by an agreement entered into at or before the time of such supply and specifically linked to relevant invoices against which the credit notes are being issued. And the second condition is that the corresponding input tax credit should be reversed by the recipient of the supply. On the right hand side of the screen, this existing provision is proposed to be replaced with new one, wherein the requirement of linking the post-sale discount with a specific agreement has been removed, and corresponding changes are also proposed in relevant section 34 for debit and credit notes. What exactly this proposal will change is that now there is no requirement of linking credit notes raised for providing post-sale discount with any specific invoices and agreements. As per the proposed amendment, the only condition for raising credit note for post-sale discount is that the recipient shall reverse corresponding input tax credit availed in its books of accounts. What does that mean? That means the value of supply as per section 15 will not include the value of such post-sale discounts wherein credit notes were issued with corresponding reversal of ITC. To implement this, relevant changes are proposed in section 15, which deals with transaction value, and section 34, which deals with credit and debit notes of the CGST Act 2017. Next amendment, which is proposed in this year's fiscal budget, is in the provision of refunds. The relevant section, which deals with the provisions of refund, is section 54 of the CGST Act 2017. So in this Union Budget 2026, two amendments have been proposed in this section of refund. First one is in subsection 6 of section 54, the facility of provisional GST refund has been extended to the cases of refunds arising out of inverted duty structure also. Earlier, this facility of provisional refund, which is equivalent to 90% of refund so claimed, was available only to the registered person claiming refund against zero rated supply of goods and services, which is now extended to inverted duty structure cases. The objective of this amendment is to reduce the working capital blockage of taxpayers dealing in inverted duty structure goods and to minimize the delay caused by lengthy verification and scrutiny of refund claims. Further, the second amendment, which is proposed in section 54, is in subsection 14, which provides for threshold of INR 1000 for claiming GST refund. So in this subsection, it is proposed to remove the threshold limit of 1000 for claiming GST refund on account of goods exported out of India with payment of tax, meaning thereby even a refund of minimum amount of which is less than INR 1000 can be claimed in case of goods exported out of India with payment of tax, which is not eligible to be paid in other cases of refunds. The last but most important amendment proposed in the GST laws is in the provisions of place of supply prescribed under Section 13 of the IGST Act 2017. This amendment was also recommended by GST Council in its 56th meeting in September 2025. In this amendment, in Union Budget 2026, it is proposed to omit Clause B of subsection 8 of Section 13 of IGST Act. That is, the place of supply of services in case of intermediary services, where the location of supplier or the location of recipient is outside India. Means either of the two should be outside India. In general cases, the place of supply of services is location of recipient of service, as we all know. However, for certain cases, specific place of supply provisions are prescribed. One of such cases, intermediary services. For provision of intermediary services, a separate place of supply is defined under Section 13, subsection 8B of the IGST Act, which is location of supplier, which in general cases is location of recipient. Due to this specific provision of place of supply for intermediary services, there are number of disputes and litigations pending at all the level of adjudication and appeals. Most of the registered persons in India which are providing services to their parent company or holding entity outside India in the nature of back office support, accounting, market research, market support, technical support, software development, market survey, etc., are grappling with disputes on account of intermediary services. Such registered person, whenever applying for refund on account of export of services, are being imposed with refund rejection orders by the authorities, alleging that their services are intermediary services, thereby forcing registered persons to incur time, cost, and efforts to litigate the issue at various levels. And relief is generally granted at the level of high courts and apex court, which results in blocking of working capital on account of delay in sanctioning of refund. This recommendation of GST Council in its last meeting and consequent proposal by government in Union Budget 2026 is a welcoming move for registered taxpayers, since it will allow clarity on the provisions of place of supply in case of intermediary services by making it to be governed by default provision, which is location of recipient, and consequently reduce the number of disputes and litigations. Now, we are moving forward to the changes proposed in the Customs Act 1962. It is proposed to extend the custom jurisdiction beyond India's territorial waters for fishing and fishing related activities by amending Section 1, subsection 2 of the Act. The proposed amendment reads as can be seen on the screen, that the Act extends to whole of India fishing and fishing related activities by Indian flagged fishing vessels beyond territorial waters of India. And to define this term, Indian flagged fishing vessels, a new clause 28A in section 2 of the Act is also inserted, which means a vessel used or intended to be used for the purpose of fishing in the seas and entitled to fly the flag of India. The next amendment, which is proposed in the provision of custom laws, is addition of a new section 56A, which effectively will turn the ocean beyond 12 miles into a duty-free zone for Indian flagged fishing vessels. The proposed addition will transform the deep sea fishing sector from a strictly domestic food source into a regulated, globally competitive export industry. Further, amendment is also proposed in section 28J2 of the Act to provide time limit for validity of advance rulings, which says that an advance ruling under the Customs Act shall remain valid for a period of 5 years or until a change in laws or facts, whichever is earlier. And simultaneously, the provision of the section is also substituted to allow extension of existing rulings for 5 years upon request by the applicant. Further, Section 67 of Customs Act is also proposed to be amended to do away with the requirement of prior permission of the proper officer for removal of goods from one warehouse to another by the owner of the warehouse. Now, we will discuss the proposed amendments in custom rules. The most important amendment, which is effective from 2nd February 2026, is that the existing baggage rules 2016 are being proposed to be superseded by baggage rules 2026. And the objective behind these new baggage rules 2026 are to resolution of interpretational ambiguities arising under the existing rules, ensuring that uniform application of baggage provisions should be made applicable across all the ports in India. Also, clear provisions are introduced for goods temporarily brought into India and taken out of India. Further, these rules will be particularly beneficial for business travelers, artists, and event participants. Then, restructuring is also proposed in the transfer of resident framework, wherein the eligibility and extent of TOR benefits for Indian residents and foreign professionals are now aligned with the duration of stay abroad or in India, reflecting contemporary patterns of global mobility and employment. The next amendment proposed in deferred payment of import duty rules 2016, wherein deferred payment of import duties proposed to be made monthly instead of the existing 15-day period, and new class of eligible importers is being created. Additionally, certain export promotion measures are also introduced, wherein the value limit of duty-free imports of specified goods imported for use in processing of seafood has been increased from 1% to 3% of the FOB value of seafood products exported during the preceding financial year. The next measure is that the benefit of duty exemption on inputs for manufacture of leather footwear for export is being extended to exporters of shoe uppers also. These measures are also effective from 2nd February 2026. Changes are also proposed in social welfare surcharge and agriculture infrastructure and development cess, wherein parts of electronic toys for manufacture of electronic toys are being exempted from social welfare surcharge. Social welfare surcharge will apply on all personal imports from April 2026. Last one is that social welfare surcharge exemption for spent catalyst or ash containing precious metals will continue unchanged beyond 1st April 2026. In this Union Budget 2026, in order to promote Make in India initiatives, Basic custom duty tariff rates are being increased on many commodities like MSME and consumer goods, which includes umbrellas and umbrella parts and accessories, wherein the rates are being increased from 20% to or INR 60 per piece, whichever is higher. Chemicals and fertilizer sector, capital goods and infrastructure equipments. Also, in order to promote domestic industry, basic custom duty tariff rates are being reduced on following commodities: all personal imported goods, makhana, other roasted nuts, prawns, ship feed, seeds used for sowing and frozen turkey meat, walnuts, almonds, mining, minerals and energy sector items, certain chemical and fertilizer sector items, and reactors, columns, and chemical storage tanks. Further, certain items are also proposed to be exempted, which includes certain categories of critical minerals, metals, and EV ecosystem, which includes lithium oxide, lithium carbonate, cobalt oxides, etc. Certain power and energy sector devices, which includes nuclear power goods, control and protector absorber rods, electronic appliances, which includes microwave ovens, raw material and components or parts, including engines of aircraft. Certain amendments are also proposed in central excise laws. First one is the National Calamity Contingent Duty rate on chewing tobacco, jarda, scented tobacco and other specified tobacco products is proposed to be revised from 25% to 60% with no change in effective rate of duty, and this amendment is effective from 1st May 2026. The second amendment is in excise is that the value of biogas and the applicable GST paid on it when used in blended CNG will be excluded from the transaction value for calculating central excise duty on the blended CNG. To conclude, I would like to state that the proposed amendments and insertions announced in the budget represents that the government is taking steps to streamline the compliances and reduce the number of pending litigations, disputes, and ambiguities. Further, to apprise you all, these amendments, unless otherwise specified, will be effective from a date to be notified post enactment of the Finance Bill 2026. That's all from my side on key amendments under indirect taxes. Thank you for your patient hearing.
Thank you, Rashi, for this informative session. I hope you all have enjoyed this session on the Union Budget 2026. For any further communications, you can reach out to us on communications@mbgcorp.com. Thank you. Thank you.